The club has become aware of this past week of the death of a longtime member, Hal Templeton. Hal joined City Club in 1940 and maintained a continuous membership for nearly 53 years. We extend sympathy and best wishes to his family and friends. And finally, the club has received a number of inquiries regarding the letter that we sent to Senator Bob Packwood inviting him to use the club's forum to address the people of Oregon regarding the recent allegations. Just to keep you up to date, we've not heard anything from the senator's office. Well, in this past election, we heard a lot about change. And as Bill Clinton prepares to take office, the country anxiously awaits the changes that may be in store for the national economy as well as Oregon's economy. With us today are three speakers who will try to shed some light on what we might expect in the coming year. In order that we can hear from all of them uninterrupted, I'd like to do all three introductions before they begin their remarks. To my near right is Bill Conerly. Bill is Vice President and Economist of First Interstate Bank. Serving the 5 states of First Interstate's Northwest region, he advises senior management on the outlook for the economy and interest rates, and acts as economic advisor to Westcore Mutual Funds. He received his Ph.D. in economics from Duke University. He has taught economics at St. Andrews College and the University of San Francisco, and has worked in economic forecasting and corporate planning for Pacific Gas and Electric Company and NERCO. He's a member of Governor Barbara Roberts' Council of Economic Advisors and is president of the Oregon Council on Economic Education. Seated next to Bill and following him in the lineup of speakers is Tom Potiowsky. Tom has been a member of the economics department at Portland State University since 1983. Currently, he is department chair and professor of economics. Tom received his Ph.D. in economics from the University of Colorado in 1981. Teaching positions have included the University of Colorado and the University of Arizona. Tom's areas of concentration and publications are in macroeconomics, money and banking, econometrics, both on a national and local level. He's very active in the local chapter of National Association of Business Economists, having served as president and organizer of the annual Economic Outlook Conference. And batting cleanup is David Allen. David is manager with the Workforce Analysis section of the Employment Division. In his current responsibilities, he directs the development and delivery of workforce information, including occupational supply-demand, career information, state and regional economic and labor market analysis, and basic research into the changing structure of the Oregon workforce. Prior to his joining the Employment Division in 1980, he was an assistant professor of sociology at Western Oregon State College and received his master's degree in sociology from the University of Missouri. David will be addressing the outlook for employment in the state. So Bill Conerly will speak first, and as he takes the podium, please join me in welcoming all three of our speakers to the City Club.
Thank you. It's a pleasure to address the City Club. It's a bit of an unexpected pleasure to see such a large attendance here. I had feared that some of you might stay away to hit the post office and buy the new Elvis stamp, which came out today. It's really a momentous occasion here. It is, by my calculation, the first time since the Revolution of 1776 that Americans have used a stamp that has on it the image of the king. Those of you who read the papers may have heard that the economy ended its recession in March 1991. A few of you may even be inclined to believe that statement. I've been saying it for some time that the recession was over, and I have found that people don't believe me. Not even the usual people who don't believe me, such as my wife, but the general person on the street. And it's perhaps worth figuring out why there is this gap. Is it just the normal tendency of people to doubt economists, or is there something to it? Let me hit you with some numbers, and as always, the numbers help us get up to the level of boredom that you come to expect from economic speeches. We lost 2.1 million jobs in the recession. Since the recession is over, we have regained 250,000 jobs. That calculates to a net loss down and then part way up of about 1.8 million jobs. And yet output in this country is at an all-time record high. In terms of gross domestic product, we had a decline, that was the recession. We have regained all lost ground, that was the recovery, and we are now into what we in the jargon call the expansion, an all-time record high level of output in the United States of America. But it doesn't feel quite as good as that all-time record high would suggest. The problem is that the growth of our output has been at such a pace that we have accomplished it primarily through productivity, more output per worker. And productivity improvements are good, but what we would like to see is both productivity improvements and enough growth in demand for output that we put more people to work. And the same thing has happened at the local level, but with a little bit of an added twist. We've had an output increase. I say that with confidence because we don't have any data to confirm or deny it. We've also had an employment increase in this area, and yet at the same time we've had an employment increase. The growing population, because of the continued migration to this area, means that we have had an increase in the labor force that surpasses the growth of employment, which means we have more unemployment. Both more employment and more unemployment. The two most popular trends in Portland today are working and not working. So just as the national economy needs to have stronger growth to get employment up, we need to have even stronger growth than that to absorb into the workforce the people who are moving to this area, and we just haven't had strong enough growth. The reasons for the national weakness are primarily the causes of Oregon's weakness, and particularly the Portland metropolitan areas. Portland's biggest industry is a classification that I affectionately refer to as miscellaneous and other. It's all the businesses that don't add up to the major categories. You know, we think of wood products. In Seattle, they think of aerospace. We think of, depending upon how attuned you are, metals and food processing. But the biggest category of industry in this area are all the businesses that don't fall into the major categories. They tend to rise and fall with national and international markets, and we are looking for a little bit of improvement on the national side, a little bit of gain on the international side. So even though we have thought for many years of ourselves as a timber-dependent economy, we're really dependent on the national and international averages. Now, this weakness in national growth, which has translated into insufficient growth at the local level, has a number of causes. We have major industry restructuring in defense-related establishments and in commercial real estate. We've had consumers deciding that they had too much debt, and they have been paying down their debt. They do this by deferring expenditures on big-ticket items, and consumer spending has been soft. That's been a contributing factor. Why, I can tell you that at First Interstate, we even today have customers who are ending the month with money left over in their checking account. Not the Conerly family, I'm proud to say. This consumer retrenchment has been accompanied by business retrenchment. Businesses have deferred capital spending projects to get their balance sheets in order. They have paid down their debt. The debt that they have restructured to longer maturities and lower long-term interest rates, and they are ready to spend. I talk to customers all the time who have plans for adding productivity, improving equipment, or adding production capacity, and they're just waiting a little longer. What they're really waiting for, whether they know it or not, is for more growth of consumer spending to fuel the demand for their products, and then we'll get the business spending going on. Those two factors that have been causing weakness in the economy are going to turn around, and they're going to turn around as part of the normal cyclical forces in the economy. The final factor that has been a depressant in the recent past has been Federal Reserve policy. The Fed has tried to dampen all signs of inflation. They actually reduced the money supply early last year when the economy showed signs of strength. Now, what's going to change with the new administration? Tom's going to talk about some of the policy initiatives, but from a very short-run viewpoint, the new administration is not going to change the downsizing of the defense establishment. It's not going to lead to a resurrection of the commercial real estate industry, and in and of itself, it will not cause that turnaround in consumer and business spending. However, that turnaround in spending will be roughly coincident with the new administration. In fact, the consumer confidence started increasing, perhaps because we got the election over with. I don't know that consumer confidence increased because the election of Mr. Clinton. After all, only 43% of the populace of the electorate voted for him, but I think we're all happy to have it over with. At the risk of getting nostalgic, to compare this recent election and its impact on our attitudes with the 1984 election. Remember, in '84 we had one challenger saying things are lousy and one incumbent saying no, things are pretty good. This election we had two challengers saying things are lousy and the incumbent agreed with him. So we're looking for a turnaround in a couple of the significant factors influencing the national economy, and with our significant diversification in the Portland area, we're looking for a little bit better growth in Portland in '93 than we got in '92, but certainly not a boom. And the boom won't occur because of those two major industries, because of the Federal Reserve. And now we have an added problem in Oregon in that our neighbors, north and south, are having tremendous weakness. California with over 10% unemployment. We're forecasting the California economy continues to contract through about summer and then has some moderate rebound. In Washington, the unemployment rate just jumped up last month. We're looking for continued employment declines in the state of Washington, primarily in the Seattle area, to last for several more months, ending sometime in the spring. Our neighbor to the east, Idaho, is doing very well, and a little bit farther east and south, Utah is doing very well, but we just don't do enough trade to the east to make up for the weakness that we see north and south of us. So you put it all together, and we have a forecast of growth, but fairly restrained growth. Last year I said that the economy would be good enough that a well-run business had a good chance of making a profit, but that the economy would not bail anyone out of stupid mistakes. And so I left you with the advice of just simply don't do anything stupid. After saying that, I left my watch at the podium. I think I can wrap up this year's forecast by reminding you of the Gerald Ford administration. I see some of the younger people looking puzzled. Gerald Ford was a president of the United States some time back. And he wanted to whip inflation now, and he had printed up buttons that said WIN, W-I-N, which stood for whip inflation now. And to get in tune with the first interstate forecast for 1993, you pull out that button and you wear it upside down so that the letters spell N-I-M, which we take to stand for no immediate miracles.
Thank you, Bill. It's a pleasure being here today. As you can probably guess, this is, I'm sure many of you, this is not your first forecast that you've gone to. It's very popular this time of the year to forecast anywhere between August and this March. These type of conferences will be going on. But with a new administration in the office, and not to steal from David's talk, one of the employment outlooks that look very good are for economic forecasters. And in fact, what I might recommend is that if outgoing Mayor Bud Clark was looking for a job, I think he has what it takes to be an economic forecaster. Mr. Clark's really demonstrated that he can make very succinct, accurate forecasts, qualified with the appropriate alternative scenarios. For example, in the December Oregonian, when they profiled him, Clark was quoted, and they put it in big, bold letters, "Uncertainty is certain, at least for the next several months." And this is exactly the type of forecast that economists can really sink their teeth into. Compare this, for example, with the economic forecast that interest rates will start a strong and steady, yet mild and slow climb upwards, unless rates level off or start to decline, at least for the next several months. Well, we have to qualify our forecasts. We have no choice. As new information becomes available, we have to take that new information and work it into our forecast. So all these forecasts that you hear, and for example, in the Wednesday Oregonian, full page, right, and all the different forecasts, Bill was involved in that discussions. Remember, those things are only at the moment that those forecasts are made, and as new information comes in, they have to be qualified. They have to change. And the way I want to present my little discussion here is to tell you that you've read all these things about Clinton's programs, But the extent to which they can take place is going to depend on the type of economy that the president-elect is being handed by the president-not-elect. Right? He's going to have an economy that we can describe as having a very large budget deficit. And Clinton's ability to carry on his programs are going to have to face this deficit. Now, exactly why did Bush ignore the domestic economy over the past couple of years, or at least virtually ignore it? And part of the answer to this is what's the problem that Clinton's going to face in trying to get his programs through. Now, if you have a basic belief, as Bush does, that government should not be involved in the private economy, especially in terms of undertaking expenditures, you have a deficit problem on top of it, you face a recession that's occurred, what can you do? You can't raise expenditures. That doesn't fit your philosophy. You could try to lower taxes, but you'll probably raise the deficit up. If on top of it you believe that, well, if the government shouldn't be involved, the economy is mostly self-correcting, you do what he did, which is you don't do anything and you wait. Unfortunately for elections, timing is everything. And if he would have had the election maybe today with the good economic news that's coming out, it might have been a different election. So right now, Clinton, what sort of economy does he have? What's facing him? GDP growth, gross domestic product, grew at 3.4% this third quarter. It's looking very good. Strong Christmas retail season. Consumer confidence is up. The Fed discount rate is at a low 3%. Three-month Treasury bills are low around 3.12%. 30-year Treasury bills are up a little bit, 7.44. Expectations are they may go up a little bit more. Initial job claims are down for another term. The only bad area that it looks like is this hanging deficit that now has new projections of going up to over $400 billion for possibly 1993. So, in that light, what can Clinton do? And in terms of that, what the extent that he can do is also going to affect the overall economy and have ramifications for the Pacific Northwest. Now, there's four main areas that Clinton hopes to undertake. He hopes to undertake public sector investments in the infrastructure, look at education, health care reform, and the big one, deficit reduction. All these, depending on your viewpoint, can either work together. When he talks about health care reform, that's also going to help reduce the deficit. Or your view might be that they're in conflict with one another. If he tries to undertake his public infrastructure programs, this is going to cause a deficit to go up. And politically, that could harm him. Let's take a look at deficit reduction. Right now, California ranks #1 in defense expenditures. And we're looking at the defense expenditures going down possibly 18% over through 1995. California is going to get hit. They're already being hit by the reduction that happened last year. State of Washington ranks 8th in total expenditures. Oregon and Idaho rank in the bottom 10. And we shouldn't see much impact on this further getting around the deficit expenditures in the state of Oregon. But in terms of what Bill has mentioned, our trade with especially California and Washington should be impacted by this. And it will decrease a little bit of our out-of-state exports to these two areas. Depending on how the federal government runs things, possibly some pockets of Idaho might benefit if the federal government decides to subcontract out the Bosnia job. Public infrastructure, $80 billion per year over 4 years. Roads, bridges, national fiber, optic information networks, high-speed transport, smart highways. To the extent that he can undertake these, the big question is how he can fund these. There's been a number of proposals, different insurance programs to back the bonds. But unfortunately, the one area he would like to tap into, which is the retirement area, pension funds, they tend to shy away from public projects. And that's going to be a tough one to get by without raising the deficit up if he can get the public to hopefully buy some bonds to finance this thing. Or use what's called the peace dividend from the decrease in defense expenditures in order to undertake these public infrastructures. The education area, this is probably the brightest point because this is one where you don't necessarily have to do a lot of expenditure. You can get a lot of political mileage out of it. And in terms of retraining, working with private companies, with universities, my guess is with Robert Reich as the Secretary of Labor, he's going to see the day and be able to push through grants to universities to work with private industries for education retraining, both in terms of what we're seeing, Workforce 2000 in Oregon, we already have a start on it, all the way through to worker training, continuing education throughout a person's life. This doesn't mean that we're going to get away from Measure 5 here in Oregon, but hopefully this would soften the impact somewhat. Healthcare, right now, 12% of gross domestic product is related to healthcare. It's projected to go up to 18% of gross domestic product by the year 2000. Something has to be done. I am quite sure that the Oregon Health Plan will go through as a pilot program to serve as a template for the nation in order to try to get these healthcare expenditures under control. In terms of how that impacts here in the Northwest, depends on whether the Medicaid is going to be enough. There's still some questions about whether that expenditure will be large enough in order to cover all the different people that will now fall under this area to be able to be eligible for health care. It's also a question of whether our budget, state budget, would be able to cover any sort of exceeded expenditure on that. So I want to end just by saying that we should not expect much to happen from the Clinton proposals. Part of it is that most of his proposals are long-term, and implementation of those, both public infrastructure, health care, all of these are not going to probably happen in 1993 to any great extent. What we're going to see them is possibly implemented later. But is the economy too strong in the sense that as it builds up, will he back away from these and be afraid of causing inflation and what the monetary reserve may do in terms of decreasing the growth of the economy, and thus concentrate on decreasing the deficit instead? So it's a qualified look. As I would definitely agree with Bill, as economists always love to agree and disagree with each other. The key word is there's growth, but very slow growth. Nothing really to cheer about, but of course nothing to cry about either. Thank you.
Before stating my view of the 93 economy, I'd like to say just a few words as to why the Employment Division forecasts employment, particularly when many other people forecast employment, and also why do we forecast occupational employment into the future. The primary reason for that, of course, is that the Employment Division's mission is to promote employment. And I will deal with workforce issues in my presentation, not so much the issues of the money and economy, etc. But I will run some numbers by you, and then I'm going to run some choices by you, and hopefully there will be something in those choices that will spark something in terms of thinking about the 93 economy. First, if you look at the 93 economy in terms of the numbers, I think it's important to note that the economy is very dynamic. I don't believe most people realize how dynamic the Oregon economy is. You're talking about 1.1 million people leaving jobs in a year, about 1 million new hires, and about 280,000 different people experiencing unemployment during the year. Now that's different than the unemployment rate. That's just the numbers of people who experience it during the year. So you have a very dynamic economy with people going in and out, leaving jobs, etc. Incidentally, that kind of numbers are about the kind of numbers we had in about from 86 to 87. So that's the kind of economy we're talking about. The second set of numbers I want to talk about is that the employment for 93 looks good but not great. I would agree with the other two speakers on that point. Last year's economy created about 17 to 20,000 new jobs. The 93 figure will be somewhere around 30,000 new jobs. Not bad, but not nearly the rapid growth we had in the 87-89 period, in which we were creating about 50,000 new jobs each year. So that gives you kind of a relative picture, if you will, of what we're projecting for the 93 economy. But of course, much better than the 91, in which we actually lost employment. So again, 93 looks pretty good. The third set of numbers I want to talk about are the unemployment picture. And in this particular case, things do not look so good. The 92 unemployment average will come in at about 7.3%. 93 is projected to come in at about 7%. And the error of that estimate can certainly make up that difference. In fact, if you lose your job in the 93 economy, you will find out at least one thing that is wrong with the economy. It is very difficult to find a good job and for you to have a chance of getting one of those good jobs. The problem is that job seekers have been growing faster than the jobs that are being created. But that's only part of the story. That story has already been mentioned. What you will find out as a job seeker is that there are a lot of highly qualified, highly skilled people unemployed in the state of Oregon and coming into the state of Oregon, and there will be hundreds perhaps of applications and resumes that an employer can choose from, almost no matter what the occupational field is. And you may have a hard time competing in that arena, particularly even if you're highly skilled, because your skill may be very narrow to that particular area in which you have been trained and have been working in the last number of years. And you will also find that the occupations in demand in the state of Oregon are primarily the professional, technical kinds of occupations requiring considerably more education than high school. That's a very important point. We have many Oregonians that once they become unemployed, even though they're highly trained in their particular field, have a very difficult time re-entering that labor market and finding a good job. In fact, this demand-supply picture is, for most of us, what is really important about the employment numbers. Why? Let me just give this little scenario, and perhaps you have these same feelings. We may feel that our jobs are at risk, that our wages and benefits have not kept up with our desired standard of living, that the taxes are increasingly harder to pay. We may also feel that the majority of us are getting poor, while the minority of us are getting richer, that the gap between the haves and the have-nots is growing. And incidentally, all of these things are true. For example, Oregon's wage income has dropped from being above the national average to about 90% of the national average in the past decade. And incidentally, so too has our productivity if you measure it by the value of our output per worker. Now, I do not have time to explain why this is happening to us. I think it's important, though, to acknowledge this fact, that Oregon's economy was fundamentally changed in the 1980 recession, and we have not recovered economically, even though we may have recovered. As a matter of fact, we're setting new heights in terms of employment. In other words, we had some very fundamental changes that took place during the 80s, and we have not recovered from those. Well, will the 93 economy be the turning point where we will establish careers that will lead to good jobs and a higher standard of living? I don't think so, unless we make some wise choices. In fact, I think the good employment growth of 93 may delay the tough choices, because we will think the economy will cure itself. That is, if forces beyond our control got us into this mess, and largely they were, perhaps they will cure the problem. we may not want to make the tough choices. I think this do-nothing, let's-see approach to the economy would be a serious mistake. To highlight why I think to take a more proactive role in this economy is important, let me make a few statements and perhaps make a comment or two of each. And if you understand these statements and understand why these statements are now true and in the historical past they were not true, you have some idea of the choices that we face and some of the difficulties. The first one is education is becoming the great stratifier, not the great equalizer. And if you think about that, that was the promise of the American dream, was that you could have access to education. And many of us in this room took that access to that education, either through the GI Bill or the National Defense Act or whatever. Access to education is actually shrinking. There's only one thing going up any faster in terms of cost, and that's health care. We cannot afford, in my opinion, to allow education to become the great stratifier in our economy. Oregon is becoming a low-tax, low-government, and low-wage state. Is that what we want? Some of us would think that we are actually a high-wage, high-tax, and high-government state. But if you think about it and you look at the numbers, the direction is definitely towards the low-tax, the low-government, and the low-wage state. It takes 2 average wage jobs to make 1 average household income. Think about that one. Historically, that was not true in Oregon. It takes 2 average wage jobs to have 1 average household income. I think if you think about that one for a little while, you will see a lot of the different kinds of choices that we've all had to make in order to make a standard of living make it in the state. And actually, I would say that women have saved the standard of living in the state of Oregon. If they had not come out in full force in terms of work, if they had not worked longer hours, the standard of living in the state of Oregon would have actually declined over this period of time. Well, we have a surplus of college graduates, but a shortage of skilled workers. You might want to think about that a minute. And as a matter of fact, we are creating more college graduates than there are jobs that require a college education. But that does not mean that college-educated people can't find jobs. As a matter of fact, they have a very low unemployment rate. They may at first find jobs that do not require a college education, but they find them. And that recent research has shown that no matter which job they take, no matter whether they're a laborer, a secretary, whatever, they get paid more. That college education does pay. But what do I mean by a shortage of skilled workers then? Well, if we think of a traditional sense of recruitment, employers do not have a shortage of workers. Because as I mentioned, they may have 200 applications for any job they have. But if that employer tries to bring in technology, reorganize the workforce a little bit, become a high-performance kind of organization, and be very competitive in the world economy, they will find they have a tremendous number of shortage issues before them. In fact, almost all of their employees. What choice can they make then? Well, unfortunately, one of the choices, the cure for the shortage, is that you restructure. That you bring in technology, you lay off 40% of your workers, you hire the skilled labor that you need, and you become competitive. That choice, however, what happens to those 40% of the workers who are left? Another choice of actually training that 40%, bringing in the technology, reorganizing, is a much more expensive choice, but I think a very important choice for the state of Oregon. A few more of these, perhaps that's all you can take. An average educational and set of career choices will lead to a below average income. Most of us made average choices in school. Perhaps we avoided those tough math classes, or we just got by. And perhaps our careers, we just kind of lucked into them. And perhaps it was serendipity. Well, in today's economy, if you try that approach, it will lead to poverty. And facing students today, that problem needs to get across. Because if they do not understand that, they will find out that when they go out and they find that first job, that's it. And if they don't go back to school, if they don't find some more training, if they don't find some other career choices, they're in bad shape. Well, the last statement. There is nothing wrong with low-wage jobs. It's just that more people are getting stuck in them. And that comes back to that problem again. The mobility in the economy is shrinking. And the kinds of mobility that people have are shrinking. Actually, if you look back at the whole decade of the 80s, we actually created more high-wage jobs than low-wage jobs. And that's just not only our data, but the census data shows the same thing if you look at the occupational profiles and the actual jobs, because we created more professional technical jobs, and those generally more high-wage jobs. In this current economy, it's perhaps about even. We may even be creating more low-wage jobs. But that's really not the issue. The issue is mobility. Almost all of us started with low-wage jobs. How do we move up from low-wage jobs to higher-wage jobs? It's that career ladder that's important. It's that career ladder in which the tongues and the rungs, so to speak, are missing. In summary, I think the Oregon's economy in '93 has a lot going for it. The economic forces over which we have little control, that is the low value of the dollar, low interest rates, the price of gas is good, redistribution of federal funding away from defense, our location on the Pacific Rim, and more rain and snow. All those forces we have no control over. But will we grab the opportunity in '93 to make the tough economic choices and the job development type choices, take control over our own economy, our own workforce, so that we will be more competitive and we can raise our standard of living? I will leave you with that answer. Thank you.
Well, thanks to all three of our speakers. After those sobering remarks, David, no immediate miracles from Bill Conerly and growth but slow growth from Tom Potiowsky sound pretty good. At this point, we'd like to take the first question from Susan Stone, followed by Chuck Shattuck, and then we will open it up to questions from the audience. Susan?
We know we may or may not be working, so my questions are, if you can look in your crystal ball, what do you see for interest rates in the stock market?
Yeah, thanks for asking. I had meant to say something about it. With the view that the economy will show more growth in '93 but not really strong growth, there should be upward pressure on interest rates through greater demand for credit, not really sharp upward pressures. We're anticipating short-term interest rates will rise about a percentage point this year. Long-term instruments such as a mortgage rate or a 30-year government bond up maybe 0.25%. Sometimes I say up 25 basis points plus or minus 300. The difficulty with the long-term interest rates is the short-run cyclical forces should push them up, greater demand for credit. But in the long run, I think that the financial markets have to learn that this is going to be a low-inflation world, and in a low-inflation world, interest rates are too high. So maybe they're going to come up, and then Wall Street's going to wake up and say, gee, we're a percentage point too high on long-term rates.
In terms of some of the stocks, there's been a lot of press on Clinton's programs and the type of companies that might benefit from his programs. You're looking at construction especially, the high tech, if there's going to be this national fiber optic communication network take place. If also Clinton goes with the tax credit on new investments and startups. And on R&D, high tech does well over 50% of all the R&D research is from high tech. So projections are that these stocks should do much better in the coming year. But that's qualified as to whether they've already taken this information into account, and they've already gone up a little bit, which has started to occur, and then what actually happens. Are we actually going to see these programs take place?
I'd like to address this to Bill Conerly. For many, perceptions of Oregon are the following. 1, a high-tax state. 2, diminishing government services. 3, restrictions on natural resources. And 4, constrictions on education. These are not incentives that necessarily attract new business and investment for a strong and healthy economy. How do you address these perceptions with your forecasts?
Yeah. Well, let me do those in sort of a rough, maybe reverse order. On the issue of education, educational funding is a matter of concern with the possible loss of basic school support. But there have been over 100 academic studies of the connection between what we spend on schools and what the results are, and these studies are overwhelmingly conclusive that there's no significant correlation between what we spend on schools and what we get out of them. So, we've doubled the amount of spending per pupil, and it hasn't helped educational achievement of our students. Maybe if we have a funding crisis in our schools, it's not going to hurt. In fact, if it causes a reduction in central control and administration, might help. But long run, the potential of this area depends upon workforce quality, and there's no doubt about that. I think some of the attitudes that we're developing are very positive. The Oregon Business Council's, I guess they're about to release a report on education that's going to emphasize that instead of arguing about how much money we spend, let's look at outcomes. Once we start thinking about outcomes instead of resources, we're going to make a big step ahead. The natural resources industry, wood products is down, and I'm an optimist because I think that it's not going to go down any farther, but there's not going to be a rebound. The essence of the issue is there was a short period in American history, a couple of decades, where a person with low skills could get out of high school, either through graduation or quitiation, and support a family, non-working wife, three-bedroom house, a couple of cars, boat eventually, and in the 90s, there are not going to be high-wage jobs for low-skilled people, and it really comes down to that. In terms of the attractiveness of the state, and this is the ultimate question, the attractiveness of the state, we're getting a lot of good people moving here for quality of life. And the people who move from one area to another in the country or in the world tend to be more ambitious than average. The people who move here tend to be better educated than people who stay in one place, either here or in the states of origin. So we're kind of skimming the cream of the crop of the population. And I think businesses are going to follow the quality people. Our challenge is to find a way to improve our educational system, given that money doesn't seem to make a difference.
Thank you.
I'm Richard Pope, a member. I'll blame Bill for this comment. It seems to me that an economist from Chicago once compared economic forecasts as being a tool to make astrologers look good, or something like that. Could you give us some estimate or forecast of how good your forecasts are?
Sure. The real issue on any piece of work isn't whether it's perfect, but whether it's better than the alternative. And one of the things I look at is how I'm doing compared with what I think the man on the street forecast is, and is my institution better off listening to me than listening to some vice president make a wild-ass guess? And on that basis, I believe that I've been successful. And the other thing I will guarantee is that my forecast is worth every penny you pay for it.
I'm Ray Polani, a member of the City Club. I think I have a question for Tom Potiowsky. You mentioned the problem of debt, federal debt, the problem of the deficit, and the problem of investing, all of which seem to be asking for additional money or additional revenue. And my question is, what about a gradual but continuing increase in federal gasoline taxes to bring us more to the level worldwide. What do you think of that?
That's an excellent idea. Europe had this for quite a long time now. You get nice spillover effects for the environment. Public transportation looks much better, more viable. Over in Europe, it's just a wonderful public transportation system. Here, various areas, right, you have to wait, and it's inconvenient at times, and unless it had better funding and a better ridership, it wouldn't go as well. So, and on top of that, then, you're helping out basically a non-renewable resource. I think it gives a better timeline to it, allows for other alternative sources of energy to be used, and there should be a dividend from that for also undertaking some of these public expenditures. So, yeah, I see it as an excellent idea.
I guess to Bill. I'm one of the statistics. I moved here from out of state for the quality of life, moved to Portland. I'm a high-level marketing person, lots of education, 15 years experience, cannot find a job. And I know you approach this with humor. It's not real humorous on this side. I, too, have found that everything, the industry in this area is lumped into the miscellaneous and other category. Can you give me some kind of clue who in that category is in a not sit and wait and see what happens or is in a growth mode? I mean, since it's not so obvious who to approach, who would be in a growth mode, can you give me a clue?
Yeah. Well, the easy one to say is healthcare. That's a growing field. We've had increases in high-tech employment. You wouldn't know that from reading the papers, but on net we've had more gains than losses there. Those are the two that come to mind. David, do you have thoughts on which industries have been the growing ones?
Well, I think most of the professional, technical kinds of occupations, and perhaps your area, go across a number of different industries. So I don't know if it's picking the right horse, so to speak, but I think it's very important that you would market across all of the industries that you would think that would use a marketing kind of skill. Actually, it's been a growth area in terms of marketing, but you come right back to the point that people who have those high-wage marketing type jobs keep a hold of them, or when they move while they're employed. As a matter of fact, that's probably the biggest point about the employment picture. Most people get jobs when they're already employed. So once you become unemployed, you are at a tremendous disadvantage in the labor market. Virtually 95% of all the jobs are filled by people who are already employed. I don't know whether that helps you out any, but I think it's very important to actually market across a lot of industries.
Taker.
Okay.
Mike Prozan, City Club member. Dr. Conerly, we saw a lot during the Economic Summit about expanding bank lending. Is it realistic for businesses to expect the administration to take steps in that direction? What direction will the administration take? And what extent will those steps actually expand lending?
Yeah. The biggest cause of the reduction in bank lending for commercial loans has been reduced demand for loans. Businesses are financing more of their activities through their own flow of funds. With a strengthening economy, we are forecasting that we're going to be making more loans because our customers are going to want more loans. Most of the banks in this area have the capability to be making more loans now. We do have a regulatory burden that makes it more difficult to make certain kinds of loans, makes it more costly to do almost every loan, and President-elect Clinton has talked about doing this. I think that there are ways they could clarify environmental liability. You cannot get a loan on a piece of land from a bank if that land has ever come anywhere close to a toxic chemical. So anything that's been a manufacturing site in the entire history of the land, forget about getting a loan there. Not that that's too broad a statement, but that's the kind of problem we're dealing with. In terms of whether we're going to see anything from Clinton, he wants to do that, but if he tries to do more than one or two things this year, he's not going to accomplish anything. And if he does concentrate on one or two or three things, it's not going to be bank reform.
Kogan, City Club member. Mr. Connolly or anyone else who wants to comment, you mentioned, though, specifically about the statistics on education and not making any difference in how much money is spent. I assume you were talking about K through 12. What about the restrictions to access that are occurring in our state and going to be continuing to occur in our state as a result of cutbacks in funding for higher ed going all the way from community colleges all the way up?
Yeah. You know, I had thought 20 years ago we were pushing too many people through the colleges, and it turns out I was wrong, as shown by the evidence that more education is really being rewarded by the marketplace here. And given the much stronger rewards that the marketplace gives to a college education than ever before, I don't think it's unreasonable to ask the people who are going to reap those rewards to pay more of the cost. So I don't see that we need to be subsidizing tuition to the extent that we have. The other thing is we run higher education in an incredibly stupid way here. I mean, take a blank piece of paper and draw a higher ed system for Oregon. The first mistake you're making is drawing a higher ed system for Oregon. Why don't we get together with the other states in the Northwest and say, hey, let's look at a regional basis. Does every state need an ag university? The other thing we could do, even if we do limit ourselves to Oregon, is who would pick to have two major universities in Corvallis and Eugene? All of you ducks and beavers there are probably the real problem to getting anything changed. Those alumni ties keep you from saying, okay, I'll sacrifice my school. We waste a lot of money in this state, and maybe it shows that the education hasn't taken.
I'd like to make a few remarks in terms of education. The state of Oregon has recently embarked on an educational reform process, and primarily it's a reform process for those 70% of people who historically have not gone on to college. It may cost us more money. I may diverge from the other speaker. It may cost us more money to reform education so that we do create a better workforce. We don't know exactly what that's going to mean at this point, but I think it's very important that we not just focus on the college education. It's true, that's what pays off the most. But if we're going to compete internationally, it's not going to be on the number of college-educated people we have. It's going to be on the level of education and training that the average worker in the state has.
For the higher education system, in one sense, things like Measure 5, which is occurring like somewhere like 34 states in the U.S., have something similar to this, where budgets are being dropped from anywhere from 20 to 40% for higher education. It's a curse and a blessing at the same time. One of the things that have been brought up that I think is very true at universities is that they have become almost exclusively, even down to the state level, research universities. This meant that graduate students did almost all the teaching. Very few of the full-time faculty were involved in teaching at all. Based on where the incentives and the payoffs were, they only concentrated on which publication they would get. And promotions and so on only depended on that. It's coming back now to haunt the universities. They have to go back to teaching and reassessing what they do right. So, but at the same time, the approach of just cutting off 30% off the top and doing it as fast as you can is not going to help the situation. Human capital is one of the strongest and most productive items we have in the U.S. Internationally, the U.S. university system is the best in the world. It's amazing the number of international students that just come into the Portland area because of the school system. So I agree with Bill, restructuring is definitely needed. but I think we're risking also hurting our human capital potential if we do it too quickly and too deeply.
I'm Walt Roberts, City Club member, and about being proactive about the environment that we're moving into in 1993 and looking at, on the national level, the process that we go through in trying to forge ahead into the future with some proactivity. My question has to do with, it's open to anyone on the panel, do you see any shining lights, any cause to be positive about leadership and the process or programs that, for example, Clinton's economic conference, was that a sham, or was that an example of a new piece of a process for moving forward? And likewise, in the state of Oregon, is there anything in terms of our economic environment and our future that really stands out as something to hang our hat on, to really?
I'd like to start in terms of the state of Oregon. Perhaps Oregonians do not really realize it, but the last legislative session, the governor and the legislation got together, in a sense, and they said workforce issues are our #1 set of issues in this state. And I think that the leadership shown in the state of Oregon over those issues should be commended. I'm not sure that the Workforce Quality Council and all of the kinds of activities that are going on are understood very well by most Oregonians. But it is the case that in terms of this particular issue, the governor and the legislature have been together on it. So I think in terms of that leadership, that is to me one of the biggest, brightest stars, is we are focusing on a very important issue in the state of Oregon.
This will be our last question. We'll have to make it brief.
Well, I come from the energy field, and yes, we're running out of it. And yes, it is very cost-effective to buy energy in the Northwest. But now we're facing an energy deficit, and we're facing increasing energy costs. We're looking at rural Oregon, rural Washington, Idaho, and Montana. Can you take your forecast outside of Portland Metro and see what possibly the future is for creation of jobs outside of major metropolitan centers, where the jobs have been lost and where they're needed?
Well, the trend to move out of the rural areas into the cities is about at least 2 centuries old in this country, and I think it's going to continue. There may be some smaller cities that continue to grow. Salem's been growing, but basically people are going to continue, I think, to move out of the smaller communities. The smaller communities are more often natural resource-based communities, and farming efficiency is improving. We're doing less logging, both because of efficiency gains and environmental restrictions. The only bright spot for the rural communities in terms of people going there are the technological advances that allow telecommuting. With a fax and a modem and a computer and a phone, you can do a lot. But I think that that's just going to be a few isolated pockets. I think movement to the metro areas will continue. If there's any reason for it to stop, I'm not imaginative enough to figure it out.
Only bright area might be with the NAFTA coming through. I don't see much changes with Canada, given the agreements before that. But with Mexico, it appears that there might be a net gain in trade for especially the horticultural products going down to Mexico, and some grain feed, oil seed, things that also are going to be related to Mexico's projected increase in poultry and livestock and feeding that. So agriculture in the rural areas could gain somewhat from that, and that might be a bright point for them. But otherwise, there's not that much to look forward to.
Well, I might briefly come back to the workforce issues. It is the case in terms of the have and have-nots. The urban versus the rural is certainly developed in the state of Oregon, and that historically was not really true. I think that in those rural areas, they will need the same kinds of skills to market that are needed in the urban areas. And I do think that technology will assist in that arena. But I think they have to think about what are the skills required in the economy and not just what are the skills required in that local region.
Well, all these discussions of forecasts and how good they are remind me of that sage economist who, when talking with his new protege, said, now when you go out on the economic circuit and you're talking about forecasts, give them a date or give them a number, but don't give them both in the same forecast. And I think today we did get some dates and numbers in the same forecast and some other very strong statements, and we thank our speakers very much for that. And the only forecast I would make is that next January we'll be talking about the economy again. Thanks very much, and we're adjourned.